Welcome back, you lovely people. In today's video, we're going to set a target date for our cycle peak. So a really important video. We're going to be building off of the work we've already done. Please do hit the like button if the work we've already done has been useful so far. So we're going to use this log chart that we've used a few times before, or many times before. Continually building off of our work and refining our work. And a brief observation before we get started. If you remember, we put in these pink lines, which were the monthly resistance. Look over here in 2013, when we broke to the upside, it was explosive. In 2017, when we broke to the upside, it was explosive. Even earlier or late last year, when we broke to the upside, that was our explosive move up to 64,000. And would you believe it? Of course, we believe it. We're about to break that monthly resistance to the upside, or we are breaking at the moment. So over the next couple of months, we would expect this explosive move that we've seen every time that it's happened in the past. And of course, that is exactly what we expect and what we've been planning for. Even when many of us were capitulating during the mid-cycle shakeout, or even during the pullback after the first channel. But let's get down to business and talk about our targets for cycle peak. And we'll start by covering our previous targets, which are over here. Now, if you remember on previous videos, we had this range that was in from approximately the middle of October to mid to end of December. The earlier part of the range was based on how many days it was from the halving compared to the last cycle. We also did a block count, which was about a month later. And then we were looking at the number of days from the mid-cycle shakeout that was giving us that range. Now, it's of course clear to us all, based on looking at these dates, that the earlier part of that range was the 19th of October, and today is the 16th of October. So it is safe to say that we're not going to be hitting the earliest part of the range, which is absolutely fine, because A, it is a range, and B, we continue to refine our work. So it does not look like the market is looking at that date of the 19th of October. It's not looking at the number of days from the halving to the cycle peak in the last cycle. And that allows us to do one more thing as well, because if you remember from our Bitcoin model comparison, the KS model, part of that thesis was very much that this 19th of October date is very important, and the market remembers that date. And Ken is looking for what I would call a triple wave, so the 64,000 mid-cycle, but then before or around the 19th of October, he was looking for a big move to the upside into the six figures, followed by a third wave into next year. And we're not seeing that second wave at the moment. Of course, we've made a nice move up to 60,000, but it doesn't look like we're going to 100, 150,000 over the next couple of days. Therefore, at this point, we would rule out the KS model taking place. And we are absolutely fine with that, because it was never our baseline. That was just being aware of all of the different models out there, especially the ones from people who have a history of being right. But for now, the KS model very much is on the back burner, and we come back, or we remain on our base case scenario, but we need to refine our range. So how do we do that? Well, firstly, I want to give enormous credit to my coach and my community that I'm part of, Conquer the Markets community. At the mid-cycle shakeout, if you look at this graph, this was around the 21st of July, which was the white line. What they did at this time is they lined their model up with the mid-cycle shakeout in 2013 and 2017. You can see this is 2013 where my cursor is here, 2017 when my cursor is here, and they lined up these dates, expecting or building a thesis that from the mid-cycle shakeout, we would follow a very similar trend through to cycle peak. And that trend would be a wave 1, which we have now seen, a correction after wave 1, a wave 2, and it looks like we are approximately halfway into that second wave, a correction after wave 2, and a lift off into cycle peak. And that thesis was made back here in July, and we have absolutely had wave 1 as expected. Even the peak of wave 1, where my cursor is here, aligns almost perfectly with the peak of wave 1 in 2017, and was only slightly before the peak of wave 1 in 2013. So that looks very, very similar. The pullback looks similar to 2017, not quite looking similar to 2013, but that's fine. And now the second wave, we're coming up very, very close to 2017. And it looks like we may end up catching 2013 soon. And at that point, we'd be looking for a pullback. And you can see that pullback here in 2017, which would be the end of the second wave. And in 2013, that would be here. So that happens at around the same time. And if we just have a look down, that is coming in at around the middle of November, I'd say early to middle of November, based on the Conquer the Markets model. So the main takeaway from that is that lining the dates up from the bottom of the mid-cycle shakeout is so far proving to be extremely accurate. So we want to use that thesis and implement that on our model. And let's do that right now. So I'm going to actually remove these dates here, which was the 21st of October and the 15th of November. And we will start by looking at how many days it was from the mid-cycle shakeout to the cycle peak. So in 2017, we had here, which was actually coming in 16th of July to the peak. That was 154 days. And in 2013, the other reason why this is potentially quite accurate is 2013 is about here. We don't need to be exact to the day, 152 days. So a lot of symmetry there, 152 and 154 days. So I already have in here, well, if we measure it out from the bottom of the mid-cycle shakeout in 2021, let me get that right. So I'm going to say that was here, the 20th of July, 154 days. I already have it drawn in there. Takes us to the 21st of December. Of course, 152 days would be the 19th of December. I'm not going to put that in as it is so close. We'll just use 154 days. Now, with the first wave after the mid-cycle shakeout also being lining up very nicely with previous cycles, we can use that as a data point. So in 2017, here was the mid-cycle shakeout into the first wave. And then we had the correction after the first wave. So the bottom of that correction to the cycle peak was 93 days. In 2013, we had it over here. This was the bottom of the correction after the first wave. Into cycle peak was, let me come in a bit closer. That was 63 days in 2013. I've forgotten this one now. Let me do that again. So 63 days in 2013 and 93 days in 2017. Let's draw that in. So from the bottom of the correction after the first wave, it was between 63 days, which was the 23rd of November, or 93 days, which again takes us right in there. That's actually the 23rd of December. So that helps us create our range. I'm going to put in 63 days, the 23rd of November in here. And that is, let's write that in. So 63 days from the bottom of wave one correction. And actually what we need to do, the end of our range is 2 days out, or was it 3 days out? Let me measure that again. 93 days, get this as accurate as possible. Takes us to the 23rd of December. So I'll move this one out, 23rd of December. I'll relabel that, which is actually 93 days from the bottom of wave one correction. And that was 2017. The other one was 2013. And what we know, let me write this in, 2013. What we know, that range, the 23rd of November to the it was meant to be the 23rd of December. Yeah, 23rd of November to 23rd of December gives us an exact month. That also is from, we've measured from the bottom of the wave one correction on both previous cycles, but it also incorporates if we were to measure from the bottom of the mid-cycle shakeout. So that gives us a very clear range to be aiming for. Let me just zoom out, see how that looks like on the full log chart. I can remove these targets which I had in before. Now we just have that really clear range. And you can see what we will need to do in order to meet our targets. Actually the top of this log channel, which we've been watching, we can see what price will be coming in at. Let me make this pretty. So with our new range, as we come into the top of this channel, which is this box here, let me draw a box around it in here. The price is coming in at somewhere around $300,000 or just above. And of course, our target is and has always been $296,000. So we continue to see a lot of confluence in our targets, in how the data is lining up. Of course, we need to do a lot of work to get there. We're potentially saying that the peak is just over a month away and up to 2 and a bit months away, and we're at $61,600 now, and we're aiming for $300,000 plus. So that would be, if my maths is good, 120, 180, 240, that is a 400% move in the matter of a couple of months. Of course, though, we do know that that's exactly what we expect to see towards cycle peak. Finally, of course, we have our final model, which is around lengthening cycles, and you will continue to see analysts, experts, influencers out there who are talking about lengthening cycles, who are saying that we're going into 2022. And simply for us, it's kind of irrelevant at this stage. Our model continues to hold true. And it has, of course, served us perfectly well to this point, whilst many others were capitulating, panicking. And therefore, we continue to follow it until it breaks. If we get to the end of our range, let's say coming up to mid-December, and we are not having a parabolic blow off top, then that's absolutely fine. That means that we're potentially looking into next year, and at that point we will again reevaluate the model and refine the model. And that's all that we're doing at the moment, is refining, because our thesis has been absolutely bang on so far. As the data presents itself, we continue to refine our model. So we are in a power position. If we don't get a parabolic blow off top before the end of this year, then we are hodling the best performing asset of all time and looking forward to a blow off top next year. If you're looking for lengthening cycles as your base case, i.e. you're expecting it to go to March, April, May 2022, and we start having a blow off top at the end of this year, then that's not a position of power, because at that point, you're going to have to very, very quickly try and figure out what is going on and try and figure out a strategy. So I'd certainly prefer to be in our boat than anybody else's. And next, we will be thinking about what that looks like, what that exit strategy looks like. And the follow-up videos from this will be focusing on what that exit strategy looks like now that we're coming up to the all-time high, now that we have a refined range, which could be just over a month away. It's time to start defining exactly what we're looking for and how we would execute against that at cycle peak. So that's coming soon, but for now, enjoy the ride. We've put in a lot of hard work. Enjoy what Bitcoin is doing. These moments are to be savored. Don't get too distracted with everything else out there, because this is really a glorious time. Bitcoin is doing what Bitcoin was designed to do, and we have been preparing for this for a long time. So make sure you enjoy the cycle, enjoy the journey. Don't concentrate too much on the end goal. But of course, we will start preparing for it very, very shortly. So thank you for supporting me and the video and the community, and I'll talk to you soon.